All right, good morning, friends. Welcome to today's private group coaching call. Great to have you here today. As always, remember, you're trading and investing at your own risk. Very important disclaimer, especially for those of you who are new. I am not an investment advisor. Follow the Money is not providing custom investment advice or financial advice. It's very important that you realize that we provide this for educational and informational purposes to help you grow and for your research purposes. You should always reach out to a trusted financial advisor before you make any financial decisions. Okay, let's talk about today's agenda. So we got a lot to talk about today. First of all, charting the markets. We're going to look at several charts this morning, see what's going on. I also want to do a monthly candlestick review. I've talked about monthly candlesticks before on these calls. They're very, very powerful. At the end of every month, it's really wise for you to go in and take a look at your investments or your trades or whatever you're doing in the market, or even just general analysis, and look at the monthly candles, right? We're going to look at some monthly candles today, see what's going on, and I'll talk to you about how we use those and incorporate that analysis into our overall strategy. And then, assuming we have some time left over, we'll get into some trader Q&A. All right, so let's go ahead and move forward. Major market charts. Let's take a look at a few things here. Key levels, market moving averages, and some trends. Here's the S&P 500. So now when you look at this chart, what is this chart? You'll notice that I always stress to you what kind of time frame we're dealing with whenever we put one of these charts up. Daily chart, right? This is an important distinction. The daily chart can only tell you so much. It's very good, but it's just one time frame, right? You can look at a weekly chart. You can look at a monthly chart. And today, as I mentioned, we're going to look at some monthly charts and show how that analysis of those longer time periods can be incorporated into our overall analysis. But a daily chart is very powerful. And when we look at a daily chart, you know, there's several moving averages that you can look at. We look at a 200-day moving average often, especially if we're close to that range, or if we want to know how far extended we are from that range. The 200-day moving average is a really powerful long-term moving average that tells us a lot. Another one that many people look at is the 50-day moving average, right? So the 50-day moving average is very powerful. And then we also have, and that would be a 10-week, that would be like a 10-week moving average, right? 200-day would be what we would say would be a 10-month moving average. Okay, and then the 120-day SMA is one that I like to use. I like to use the 100 or the 120-day. Oftentimes, I'll look at a market and I'll apply those and I'll look historically. Some really respond well to their 120. Some respond well to their 100. And what I mean by responding is that they may find support at that area. They may react in a certain way at that area historically. And so just knowing that. So in the case of the S&P 500, over the last many months, you know, we've seen the 120 serve as support. So we saw a pullback here to the 120-day moving average right here, and then a rebound off of that. And then we saw pullbacks to the 50. Look at this 50 bounce here. So support, the S&P 500 pulls back and gets support right off of that area, pulls back to the 50-day moving average, tangles for a moment, but then rallies again, pulls back to the 50-day moving average and bounces back off of it, pulls back again to it here, bounces off of it, pulls back to the 50, and then bounces off. What's the lesson? What's the story? What's the takeaway? The 50-day moving average is, for the last 6 times, has been a buy signal, right? So that tells a story. That tells us something we want to know. So we would watch 50-day moving average support. A breakdown below the 50-day moving average support won't mean that the trend is over, but if we break down below that level, what are we going to be doing? We're going to be looking at the 120, because if the 120 also is violated or breaks down, then we're going to be potentially moving into some problems. So then what we would look at the 200-day moving average. Now, there's no 200-day moving average on this chart because it would just clutter it up. I mean, the 200-day is down here somewhere, and it's not relevant here on this particular chart because the 50 is holding and the 120 is also holding. So we're really just focused in more near term on these areas, right? So overall, position and long-term uptrend intact. and the S&P 500 just continues to power higher, and it's trading just below the all-time high that was set earlier this month. We may break out to a new all-time high in the coming days. Now, we talked about how sell in May and go away is in effect right now. That's that theory, that idea is in effect. Although the last few years, the sell in May and go away strategy didn't really work so well. It doesn't always work. There's no silver bullet in the market, but it's something to keep in mind. And so we'll see if the sell in May strategy this year works, or if it, like in years past, over the last several years, it just doesn't really have much power, right? So we'll just be paying attention to that, but we want to know what seasonal factors might be in play as we head into the future. Here's the Nasdaq. So this is one that I trade personally. I own QQQ. I like the Nasdaq 100. Why do I like the Nasdaq 100? Well, I did a teaching on why I own and trade the Nasdaq 100. And in fact, if you're confused about trading and investing and kind of the conflation between them, I urge you to go back and watch our teaching. Just go to Follow the Money and type in Nasdaq 100 in the search bar, and you'll find my Nasdaq 100 teaching. And there I show you exactly how I invest long-term in QQQ, but then take my knowledge of that particular index that I have researched, focused upon, drilled down deep, and then decided to invest in it as a long-term investment in my long-term investment portfolio. And then I trade around that. So I use trading on my long-term investment as a hedging strategy and as also a way to amplify the gains from that long-term investment strategy. So instead of just getting the regular gains I would get from holding QQQ over time, I use leveraged ETFs to trade around that long-term position. And so whenever the market begins to maybe buckle, I'll get some short exposure so that I'm still making money on the way down, which offsets some of the losses that I'm making or that I'm losing, on QQQ. And then whenever the market is charging higher, I'm looking to use a leveraged ETF on the upside to amplify the gains that I would be making traditionally on QQQ. So when I look at QQQ, I don't like to overanalyze these things. Many people overanalyze this stuff to death. I mean, and it's just too much, right? Just too much. So to me, I just try to keep it simple. You look for key areas of support. The $300 level on QQQ is a key area. If we break down below 300, I would be short. I would be short the Nasdaq 100 with a trade. That way, so as to take advantage of any further downside, right? But above 300, it's hard to be short this rally. I mean, it's pretty much just continuing to move higher. And look how this 120-day moving average is working on the Nasdaq 100, as you can see right here, right? So most pullbacks to the 120 have been what? Buy signals, right? So a pullback here, buy signal, right? So a breakdown, though, below the $300 level would signal to me that, something has changed. And plus, that's a heady area. The $300 level is a psychologically important level because anytime you have 100, 200, 300, those are key areas as opposed to 322, right? That's going to be somewhat supportive at the 120, but that's not a huge psychological impact on people when they hear that it crossed below 322. Nobody cares. But if the QQQ falls below 300, well, then that's suddenly more pervasive. That's more important. That's more psychologically powerful. And so that can be a psychological level. So the big round 100 levels, 100, 200, 300, 400, and even the 50 levels, 150, 250, 350, those can be key levels just from a psychological perspective. So it doesn't mean you're going to do anything necessarily, but in this case, the 300 level would actually coincide with a breakdown of the overall near-term trend. And so in that case, it might build a bearish thesis. And in that case, I might want to get a little bit of short exposure so as to protect my gains, right, in the long-term investment fund that I have QQQ in. All right, let's take a look at gold for a minute. So gold, we have two moving averages here on the chart. We have a 200-day moving average, and we also have the 50-day moving average. And the 50-day moving average is still below the 200-day moving average. This is what we call a death cross. Sounds pretty scary, doesn't it? Whenever the 50-day moving average crosses below the 200-day moving average, it's really not a big deal, and in fact, doesn't really tell you much at all, except for the fact that there is somewhat of a technical event here that's happening. But usually, it's not an early indication. It's usually a laggard kind of a signal. So we don't really use those or put too much stock in them, but they are events that do occur. You can see that gold came down and double bottomed here in March and April, and then began to rally. Came right up to its 50, and then spent a few days thinking about it, and then powered right through, and then didn't look back, right? So gold really charging higher. May 7th, we called a new position uptrend on gold. We've had a long-term uptrend alert on gold since February of 1st of 2019. But then we called a new position. We detected a new position uptrend in gold back on May 7th. And we issued that out when gold was around 1830. Since that time, gold has powered higher. Then it crossed through its 200-day moving average here in the middle of last month. And then it's just been going up nicely. So we've had several consecutive weeks now of gains for gold. And you can see that the trend is really improving. But that 50 is still below the 200-day moving average. When that crosses above, say, if this continues, we're going to see a 50 cross above the 200, and then you'll see in the media, they'll start talking about this golden cross that's happened on gold. That's when the 50 crosses above the 200-day. It's often a late or a lagging indicator that things are improving. So hopefully that'll happen. We're up 5% since the May 7th uptrend alert on gold. That's not too bad, considering, gold has been just kind of grinding sideways. As you can see, this goes back to November, and we're still trading below those November and December highs on gold. Now, you go back to a longer, kind of zoom out and take a look at a longer time frame. Here we go back to the original uptrend that we called back in February. We issued an uptrend alert to all of our members at around $1,300 on gold, and it meandered for a bit. These long-term uptrend alerts don't always just, immediately lead to massive gains, right? The long-term, uptrends, they can take, months and even years, to fully develop. And you can see here, surely, gold soared, from 2019, 2020, and then, of course, you have this little cave in here, but that didn't do anything to the long-term uptrend. And then you can see that it continued higher, peaked out just above $2,000 back in August. And since that time, it's been digesting, those pretty big, hefty gains. But we've been moving back and forth inside of this bearish channel in a long-term uptrend, right? So it's consolidating those gains. And now we've recently broke out. We detected that new position uptrend. There it is now in context. And you can see we've broken out above this bearish channel. So gold is now moving higher, up about 42% since our 2019 alert that we issued to members. Gold miners also continuing to do well. We issued a new position uptrend alert on GDX. This is a basket of gold miners. We issued an uptrend alert on this back on the 16th of April, about 3604. It's up about 10% since that time. There's the 200-day moving average here. You can see. Then we had a 200-day moving average breakout that occurred last month, and gold miners are up there now. Now, notice what's happening right now in the gold mining space is you have this tight consolidation, right? Tight, look at that, real tight, just kind of grinding back. GDX 40 on the top and about 39 on the lower end. So just kind of bouncing back and forth inside of this. What does that mean? Well, that means that the market is looking for direction. It's consolidating these big gains. Look, it runs from 34 basically at the beginning of May to 40 by the middle of the month. So in 2 weeks, it runs big, right? Big right here. And so that necessitates a period of consolidation where they simply consolidate those gains and the number of buyers and the number of sellers kind of equals. So it just stays in a grind. We would expect that gold miners are going to continue to move higher along with gold in this environment, that really depends upon a few key metrics. It's going to depend upon a continual fall in interest rates. It's going to depend upon, because again, if you can get a good amount of money from bonds, if the rate is increasing in bonds, then that takes a little bit of the shine, if so to speak, off of gold, because gold is much more of a hedge investment and less of a get-rich-quick investment or a sexy tech stock kind of investment. So people tend to move into gold when they're a little bit worried about what might be happening. And if they're worried, they also look at bonds. And if bonds are paying an increasing yield and they're rising, well, then they become more attractive in some cases than gold would be in some portfolio managers' ideas or minds. And so as long as rates continue to ease off a little bit here, that would be bullish for gold. Also, if the consumer price data continues to show increases. We just went we do a big monthly grocery trip up to the grocery store, once a month at one place. We shop at a couple of different places. And, the last bill we saw, we just did it this week, and much of the stuff we were buying, we noticed went up. And if it didn't go up, the size of the package has shrunk, right? So these producers are dealing with higher input costs, and they're passing them on to the user. I mean, if you've been shopping anytime lately, you're probably noticing it too. Maybe not, but it seems like we are. We're looking at and comparing receipts and going, man, we've noticed a pretty sustained increase here in prices. So as long as that price pressure continues to go higher, then that's going, of course, to be good for gold. If that transitory inflation, as the Fed calls it, begins to ease, and there's not a real fear that prices are going to go much higher, that they've kind of reached their peak and they're going to start to level out, that's going to be negative for gold. So gold as an investment is really the best way to view gold is insurance, right? That's the way I've taught about gold for years. You ever listen to Tom Cloud? That's what he explains. Gold is insurance. If you know anything about gold, you know that it's insurance, right? It's not a get-rich-quick idea. Now, gold miners are different. Gold miners are wild, so they'll run quick, and they'll amplify the gains of gold, physical gold, or they'll to the upside and to the downside. So it's a much more volatile space, and it's also a very niche space that people can get burned in really easy. So if you do trade in the gold mining space, just know that it can be a yo-yo, and you've got to really pay close attention, to that space, and just not presume that everything's just going to go higher, right? You got to watch. If you take a look here, gold miners, the GDX ETF, going back to late 2018, you'll see that GDX really respects its 250-day moving average. Doesn't mean that it won't break down below it, but you'll notice when I say it respects, you'll see it do something at that level. In other words, it won't just casually go through that level or ignore that level. So when you see it's kind of coming up back in 2018, it comes up to the 250 and then gets stuck at it. You see that for a period of a month, and then it finally blasts off and gets away from it, right? Comes up here, and then it comes back down to the 250-day, and then it doesn't just sail right through it or bounce immediately off it. It gets stuck at it. It's like sticky or something. And then finally it rallies off, and there's a big volume right there to push it off, right? So then it comes back up here, and then it comes back down, and then touches the 250, tries to rebound, and then slices right through it. The only reason it sliced right through it here was because this was the big, massive sell-off in March of 2020. Everybody's selling everything, right? So it's just selling way down, and then it comes right back up to where? To that area, and then tries again, pulls back, comes up again, stays there for about a week or two, and then rallies past it on big volume. Then we come up and we peak in August. This is GDX, and then we come back down to that nice bearish pattern that's unfolding in the uptrend. It comes down and it touches the 250, touches, tries to hold that thing, gets stuck right here for weeks at the beginning of the year, and then finally fails. And then it comes back up and fails, and then comes back up and breaks out, and then comes down and finds support at that area. And now it's in this, as we talked about, that little sideways box. You see that? There's the consolidation that's happening after that pretty nice rally that we've had so far this year, especially since the beginning of February or middle of February. So there's GDX on the charts. Now, if you look at a longer term chart here and see, we issued again the GDX long-term uptrend alert, and many of our members look for those long-term alerts and the position uptrend alerts. But, they look for those long-term uptrend alerts in the spaces that they like. And GDX is up 76% since our 2019 alert. And as I mentioned to you, gold mining is just in an uptrend alert. It's in an uptrend. And so that doesn't require us to provide daily analysis on the uptrend. It's just in an uptrend, right? So it's been in an uptrend. When it's no longer in an uptrend, we'll let you know. We'll detect it, we'll see it, we'll alert you. But right now, gold mining just remains in a nice uptrend alert, up 76% since February 1st of 2019. And it's up, as we had stated, about 10% or so since our uptrend alert issued back on April of this year when it had a new position uptrend form. Turning to silver, you can see silver again is just stuck in this wild trading range that's just been going on since August. It peaked back in August just around 30, just right below 30. And then it came down and it's been holding this area just around 23. So $23 to $30 trading range, just back and forth, right? So it's been kind of skidding along the bottom here. And also notice it's catching that 100-day moving average there, kind of riding along it. Then it falls, comes back, fights it, tries to break out, holds it, gets stuck at the 100, rallies up to the 30, comes back down, holds the 100, breaks down below the 100, can't get back above the 100, finally does, and then holds it. You see how it's grinding along the 100. You start to notice these little nuances in the charts. And then you'll see that it's lifting off of the 100, and now it's going back and it's consolidating, kind of like that we saw in gold miners. Gold is running, it's rising. Silver is grinding, it's going sideways. Looks similar to GDX right now. So a breakout above what? This level, which was hit here and here, is going to be what? Bullish, right? A breakdown below these areas is going to be what? Very bearish, right? So if we lose $23 on silver, then that's negative. Now, somebody says, can't happen, never happen. Don't be so sure, right? Those are the people who lose money, is they say that it can't happen, right? No, yes, it can. Yes, it can. So we watch 30 and we watch 23 right now on silver, right? It's up 69% since we called the uptrend back in May. Back here, it's a little off the chart here, you can't see, but about 70% on silver since the uptrend. We'll look for more upside if it breaks above 30. It might stay in this range for some more time. We'll just have to watch and monitor. The U.S. dollar. This is a chart here as well that shows that 93.50 overhead resistance. Boy, we've been talking about that for such a long time. I got another chart here we'll look at. We had a 200-day moving average breakdown back in June of 2020 after that big, huge surge in the March rally. Whenever people were freaking out and selling everything. Well, the dollar was benefiting from that. It's a hedge in times of fear. And you see that the breakdown here of the 200-day moving average right there, and then it's just, see you later. I mean, this was about 98, and then it comes all the way down. Now, notice 93.50 is where it gets caught. This is a real important area. Resistance, breakout, and then holding, and then it gets sticky right here. It's stuck right in here. And then it finally breaks down. It comes right back up. And we said, watch 93.50. It comes right up and touches 93.50 and then repels. Even after breaking out above its 200-day moving average, 93.50 was that powerful that it sent it right back down. Couldn't get above it. Came right down, and now it's hovering near its 2021 lows. Now, the U.S. dollar has been a dog for the last, many, many months, as you can see on this chart. It's been losing on average, about 1% per month over the last 12 months, right? So you just down, that's pretty big. When you think about a big, massive reserve currency like the US dollar, to lose on average about 1% a month, I mean, that's terrible. Well, imagine what it's doing to your purchasing power, my purchasing power, our purchasing power. Conversely, if you look at a chart of the, of the Chinese yuan, you're going to see something very different. The Chinese yuan is doing, really good. It's going up on average about 1%, per month, as opposed to what's happening in the dollar. Here's a real quick chart here of the Chinese yuan. And so this is the one that's leading right now in our global currency monitor. When we monitor all the different global currencies, it's the leader. The Chinese yuan is going up about 1% per month on average for the last 12 months. And so it's a beneficiary of this environment. It's benefiting in this environment. So it's holding its value and rising while the dollar is falling. So we've been talking about the yuan now for some time because of that. So it's doing well. You can see it looks the opposite. This one's going up and to the right. This one's going down and to the left, right? So the dollar it's just been tough. Here's a longer term chart that shows you the power of that 93.50 going back for, 3 decades now. So 93.50 right here, sticky, right here, sticky, right in here, sticky, and right in here, right in here. You'll see the same thing right there, and then you see it right in here, and you see it right in here. So this is a key area, 93.50, 87.50 on the downside here. We haven't touched that since 2014, but we could. So 87.50, a touchdown here might be where we finally rebound. But right now, it's looking pretty rough for the U.S. dollar, and that's putting a upward bid upon things like gold and the yuan. Here's the 10-year yield. Now, this is a chart from Friday, so it doesn't incorporate the latest data this morning. But you can see here that it had a nice run. It was falling, and this was helping stocks, and especially tech stocks, which find their valuation from a 10-year yield. They incorporate the 10-year yield in their valuation metric and their model, and so it makes tech stocks, it gives them more room in their valuations. Well, that all came to an end late last year, and it began to rise in this environment. Why? Well, because there was the expectation now, how long is the Fed going to maintain these low interest rates? And they're going to have to do something at some point. And so rates will then tend to react and rise in that kind of environment. And you see here that the 10-year yield rose and it was rising rather rapidly, right, in the beginning of the year. And that's why you saw a lot of high-flying stocks kind of top out in February, because look what's happening to this 10-year yield. I mean, it's just crushing valuations as it rises from, 1% to 1.1% to 1.3%. I mean, in a matter of days, we went from, 1% on the 10-year yield up to 1.7% in days. So, I mean, that was pretty shocking. It was kind of like what we were experiencing over here, right? And so anyway, you can see here that the yield is forming this kind of bearish channel inside of this recent uptrend that's been going on in the 10-year yield. So as long as this continues, we're probably going to see a little bit of rebound. And that's why we're seeing some rebound in tech stocks a little bit. We're seeing a little bit of course, gold is also appreciating here in this environment. But we're watching these yields because these yields are very key. The higher these go, the more pressure it's going to put on tech stocks. I mean, it really will. The 30-year yield looks pretty much the same. This is a really important yield, of course, for the many different ways. But the 30-year yield, this is what you get if you loan money to the United States government for 30 years. You get 2.26%. No, thank you. But some people will put their money in a 30-year yield and get 2.26% from the United States government. And It was just back in 2018, it was up to 3.4%, right? Then it got all the way down to 1%. That was pretty historic. A 1% 30-year yield back in March, briefly. We've rebounded off those lows. We've doubled, and now we're hanging out right in here. So kind of a little bit of a consolidation and a general weakness that's begun to creep up on yields. We'll see if that continues. Looking at a chart of Bitcoin, this goes back to about 2014. I've showed this before. This is just pretty powerful. As you can see, this is the back and forth here in Bitcoin, moving back and forth inside of this big monster bullish channel. On average, Bitcoin has delivered about 200% annualized returns since inception per year, right? 200% on average every year, annualized. That's a pretty darn good average annualized return for an asset. I don't know any other asset that's doing that. It's just been really powerful. Now, we've pulled back pretty sharply. We'll look at another chart of Bitcoin in a minute. Crude oil also bouncing up 42% since our last uptrend alert. 42% on DBO over the last 5 months, 5 or 6 months. And DBO is how we play it. Look at that 50-day moving average support, and the 200-day hasn't really been touched in some time. But DBO running up and then finding support right here at the 50-day, right here at the 50-day, right here at the 50-day. Every touch has been a buy signal, and now we're breaking out, as you can see, on DBO. So oil continuing to press higher in this environment. We told you about Brazil. It's our latest uptrend alert that we've issued on a country-based ETF. We issued that back on May 7th, the same day we issued the uptrend alert on, I want to say, gold. And as you can see here, we found support at that 200-day moving average here. We rallied. The position uptrend alert detected right here, 3801 on EWZ. This is Brazil. And now we're charging higher, up 3% today on the breakout. So nice rally here, up 5.5% since our uptrend alert on May 7th. So Brazil is moving in the right direction. And as you know, when we issue a position uptrend alert, we typically look for 20% rally or 20% gain. And that pretty much meets the goal of what we're looking for from a position uptrend. All right, so now let's move over to some monthly candles, and let's just take a look at a few things here. I want to talk about this before we close out. And I'm just going to look at several charts here. We'll zoom in so we get a nice big view, and we'll just see what's happening. So here's Cardano. As you know, I'm a long-term bull on Cardano, have owned this cryptocurrency for some time, and it's just really beginning to heat up. So there's going to be some big updates that are going to be coming out this year on Cardano, and there's going to be, the ecosystem is probably going to get pretty popular. The smart contracts are still, coming for Cardano. So it's going to represent a pretty big challenge, I would say, to Ethereum over the long term. Now, I don't tend to get into the ideas of which one's going to beat, Ethereum. There's several ones that I like. I often think of Kmart and Walmart. You remember Kmart and Walmart? When I was a kid, Kmart was fun. I remember going in and getting an icy. Kmart was colorful and the blue light specials and everything. When you're a kid, it was pretty cool. And Kmart, was a pretty big brand. I mean, everybody knew what Kmart was. It was out there. But then Walmart just totally took them down. I mean, you can't find Kmart's out of business. But you remember Kmart. I mean, I'm sure many people do. It was Kmart and Walmart, right? And Target. Target survived. But Kmart's gone. It's the same thing with things like AOL. Everybody used to use AOL, right? Everybody had AOL. Well, some people still have AOL, but it's, just not very popular anymore. There's other much bigger brands that are out there when it comes to internet connection. So the point is that we're so early in this space that what's the Kmart and what's the Walmart? What's the AOL here? What's the Friendster? What's the MySpace? And what's the Facebook? What's the Twitter and what's the other? So we're trying to figure all that out now, right? And nobody has a crystal ball. But we have decided that we like Cardano. We've been long Cardano now for quite some time. And we had wonderful opportunities to dollar cost average for the last many months. Look at this. Cardano coming down here. This is a monthly chart now, monthly candle. That means every single one of these are monthly candles. So it represents 20 days of trading. Now, when you look at a candle, you see it looks like this. This is the body. Now, the bigger the body, the longer that body is. If it's if it's like a white here is going to be bullish. It means up, and then green in this case is going to be down. It's just different with different. I could change the colors if I want to, but right now the white is bullish and the green is bearish. That means that it went down during that time. So the top of the candle is where it closed for that period. The bottom of the candle is where it opened when it's white. Okay, it's the exact opposite on the green. When you see a green, it opened right here, the 20 days there, and it closed the 20 days there. The wick that's coming down here is the price where it went during that time frame, but didn't close. Down here, same thing. It went down this low, but then closed, here, right, or here. All depends on which candle you're looking at. So when you see a long white candle like this, what does that mean? Well, it means that the bulls controlled the narrative in that space, and they were pushing the price higher, right? Whenever you see a big green candle, well, that means that the bears, got control and they pushed it down. Now, look at this long wick here. This is really, really important when you're looking at a monthly chart, or any chart for that matter, but really on this monthly chart. Let's zoom in a little bit more. And you can see that long wick at the top represents what? It represents the fact that the bulls had pushed this thing higher, right? They had really pushed it much higher. But then what happened? Then the bears, the bulls lost control, and the bears regained, and they made a pretty big comeback, and they pushed it back down by the time that time period closed. So this means that there was a rejection of higher prices ultimately during that time frame. Now, when you see that kind of wick, that's enormous. That's enormous upper wick, especially on a monthly candle. That's suggestive that the bulls may have lost control, especially whenever you see that it closes down here, right? So it closes at the bottom of this candle because it's green. It opened here. So this is a double top right here. Do you see that? Double top. It closes here, and then it closes. It opens here, and then it closes down here. So this is a double top. Even though it has this long wick, you really have a double top happening here. So all of this tells us that Cardano back in 2018 is getting ready to go down. Did it go down? It did. You see that? So you can use monthly candles to kind of see what's going on. And then when we come over here, you see that they get real tight. What does this mean? Well, this means nobody really cares what's going on, right? Nobody's really caring too much at all during this time frame. These tight little candles compared to these enormous big ones. Look at this right here. Enormous, huge candle versus this over here, right? Just nobody's paying attention. Look at the volume. It's thin, right? Look at the volume. Now notice right here, you start to get a hint that things are getting ready to improve here in the middle of 2020. What's happening? Volume is beginning to surge to the highest level we've seen since 2017, right? Early. This is back in the middle of the year when Cardano was trading at about 10 cents. Right? Many of you guys were telling me you were buying Cardano at 3 cents. You were buying it at 9 cents. I mean, some of you guys are sitting on massive, massive gains on Cardano. And that's fantastic. I'm so proud of you, for having those kind of gains. Look at this here. So we run, by the way, I have a 10-month moving average on this. What is a 10-month? Well, 10-month, we got 20 days in a month times 10 months equals what? 200. So we're looking at a 200-day moving average here, right? That's what this is. So remember, if you apply a 200 moving average to a monthly, you're not dealing with 200 days, are you? You're dealing with 200 months. Well, that's pretty long. That's like, 10 years or so, or more than that. So in that case, you want to be You want to be mindful that you have to adjust those numbers. So whenever you're on a monthly chart, if you want a 200-day moving average or to replicate it, you would use a 10 because 10 times 20 equals 200, and there's 20 days in a monthly candle. Okay, well, anyway, you can see here that things have really picked up for Cardano, and right now you can see the volume has really gotten big, right? So we have this really big candle. This one right here tells us there's probably more coming because we have this big volume. This one goes up big. Now we have kind of a sideways grind, right? We're kind of moving higher, and then we move higher here. Now notice, look at that wick. Big wick here up to the upside, and then it fails, right? And then we have this rejection of lower prices too. So, but overall, it's a good thing because it's a bullish candle. It's white. That is that we opened here and we closed here. So overall, all things being equal, that's a good thing. So even though it has a long wick here, in this case it had a long wick but it closed down. That means they lost. The bears lost control. Here, the bulls lost control. In this case, the bulls maintained control even though they got pushed back a little bit here in May. And of course, you're going to see this same kind of candle on most cryptos in the month of May because we had a crazy wild month, right? So, but overall, Cardano really held its ground, even though we had this big seismic sell-off in May. Look at Cardano's bullish candle here. Even though it has a real long upper wick and a pretty long lower wick, it held its gains. So the bulls maintained control. Now we're watching as this new candle is forming. This is the June candle, so we don't have anything to tell from this yet. We only can tell once the whole month is closed. Monthly candles are pretty useless until they've completely closed. So we're not really going to analyze, what June is doing here. Here's Bitcoin now. Now this is different. You see, Bitcoin. This is the May candle for Bitcoin. It lost. The bears regained control here on Bitcoin and pushed it down, right? Now, it did fall below its 200-day moving average briefly during May, but then notice it comes back up. So at least it rejected those lower prices and it closes back above. That's good. That's a better sign. And now notice that we're still unfolding right here below or above the 200-day moving average, which is the 10 on a monthly. Now, I also want you to see that April kind of gave us a clue here as to what might be happening. Take a look here at this particular candle right here. You see that? That's what we would call, it's almost a doji. This is right here is a pretty good example of a doji. A doji is a candle that looks like this, and it pretty flat, almost looks like a cross. Sometimes it's got a little bit of a body, but usually it's either that or just kind of flat. And you can see this is a perfect example of a doji. And what doji means, especially after you've had this big rally like this, on a monthly candle, what this suggests is that there's a little bit of indecision. There may be a trend reversal in place. So in April, we were able to tell that something we might see a sell-off coming because this represents indecision. The doji means indecision. So when you're looking at a monthly candle and you see, that kind of pattern, that means that it doesn't mean that it's going to end, but especially after it comes after a big rally, you can see the same thing on a big sell-off. If it sells off really big and then you get a doji right here, oftentimes it's going to reverse. That won't always, but sometimes it'll reverse because what's happened is it just kind of exhausted itself. It's kind of a classic exhaustion sign. So now we have this big, massive, candle that sells off from 60 down to 30, 35, 36, something like that. Okay, so there's Bitcoin. Look at Ethereum. Look at this massive, massive wick here on Ethereum. Huge wick on the top, rejecting those higher prices, but then also rejecting these lower prices. But look how it closes pretty much right where it was the month before, back in April. So you have these nice big months. This month is good. This month is good. This month starts rallying, and you keep moving higher, and then you get this strange kind of looking pattern here. Well, whenever you have these kinds of candles that are this big, it's unsustainable. They can't continue like this over and over and over again. You're going to have a little bit of a shakeout. In retrospect, here's the 2017 rally, as you'll see here, as it took off, and then there was the peak right here. Well, that was the peak right there, actually. But you can see it's kind of a double top right there, and then it begins to fall, right? And then it falls into oblivion, where it's just this crypto winter. Nobody cares. But you can begin to see there was a lot of accumulation and a lot of excitement going on here, even though it was down, pretty low in Ethereum. Again, Ethereum was trading below 250, for much of last year. It's only recently rallied to this area. So if you're able to dollar cost average, during this whole time, you were able to accumulate at really good prices. And these crypto winners, when we fall into them, it's nice time to accumulate. Gold. So gold kind of falls into this same thing here. We notice that we have this peak. Notice how these are all monthly candles. We got this nice rally. There's our long-term uptrend alert right here, February 2019. And it pulls back a little and then rallies nice. Here's the 200-day moving average right here. And we got some nice candles going along the way. And then we come all the way up here. We start getting a big candle. See these big white candles? Okay, so when we have that, then we get this look. It almost looks like a doji, doesn't it? It's indecision. It's one of those, the bears and the bulls, they couldn't quite figure out who was going to take control. And so then you're expecting, okay, well, we could see potentially a sell-off. And that's exactly what we got, right? We got a sell-off in gold. So the doji here kind of told us that we could see a trend reversal. We have these big candles and then this tight little doji with big long wick. Now we're going down, right? We come down and then we see that we have a little bit of fight here at the 200-day moving average, and then it sells off again, right? Pretty big. And then we have this other little doji here, right? So we've had this overall downdraft, and then you get a little doji here indicating we might get a reversal, and sure enough, we did. So now we're crossing back above the 200-day moving average on gold, and gold looking pretty strong here. So we got 1 and 2, monthly candles in a row that look pretty strong. In the last cycle, you can have 1, 2, 3, 4 of these. Here you had 1, 2, 3, 4 of these. And so we might get, 4 of these. Here's 1, 2, 3, 4 of these. And then suddenly you get a little bit of a sell-off, right? So, we could get 2 more months of good solid price action on gold before it begins to, maybe shake off a little bit of that and give in a little bit to the bears and give a little back before it pushes higher again. Doesn't mean that it has to be 4 months, but that seems to be the cycle right now. Silver, again, you can see something similar here. So a lot of consolidation going on right now in silver. Now, the S&P 500, let's see. So we are starting to get a little bit, you can see the things are getting a little thin. Now, I'll tell you one of the things that I like. When we start seeing these real big candles, this is exciting. Right here, whenever you have this of course is the Fed, pumping the market higher. So that's why it looks like it does. I much prefer these kinds of candles. These are much more sustainable. You see how you get a bull right here, bull. And then you get a little bit of a bear, right? And then, it's up, and then a little bit of indecision. Up, doji, up. You see, but when it gets bigger, you see that it begins to sell off, right? So I like these little itty bitty monthly candles that just keep going up because these can be sustained for quite a long time. When you get these monster candles, over and over again, that's not going to last very long, right? You're going to have a retraction, or a retracement. But these smaller little candles, boy, these can go on for some time, and I like that. So anyway, you can see right now in the S&P 500, we have this, looks like a little bit of a doji here last month. When you look at it, it's still a positive month, but overall you can tell that it's getting a little thin. So if we have a sell-off this month, it would not be surprising in the least. So if the June candle, ends up being like a big green candle that comes down, that wouldn't be surprising because we have had 1, 2, 3, 4 now positive months, and this fourth one is a little bit of a doji here. So we're watching to see what's going to happen there. Let me just, for the sake of time, let me see. I'm just going to scroll through a few more. Tron, you can see this one was bearish. This was what we call a bearish engulfing candle, right? So this one is one you want to watch out for. You have a nice big candle here, 1, 2, 3, 4, and then you have this big, massive, sell-off bearish candle, and it's bigger than the last candle, right? What we call engulfing. And so it engulfs the previous candle, telling us, oh boy, this probably isn't good near term, right? And so we would, if we do rebound, it would only be because there's a general rebound in the overall crypto space. Technically speaking, this would tend to lead to more selling pressure or at least weakness for some period of time. See if there's any more here I want to look at. I'll scroll through here. Volatility is really low. I mean, we're still hanging out. We were hanging out down here in the 10s, 15s for some time. We're back down. We were around 15 earlier. It's up about 18 now. We're due for another spike in volatility. So volatility is really calm right now. We would expect it to spike up and at some point this as we head into the fall. Monero had a rough go. Let's see. XRP, the SEC lawsuit is nearing its conclusion, and there's quite a bit of bullishness in the fact that XRP may win the SEC lawsuit. That's why we've already seen some of that priced in. We saw some really good rallies, even though the SEC is suing Ripple. We've seen a pretty good rebound here on Ripple, on expectations that it's not going to have much teeth, but we'll see. ARKW holding its 200-day. Block rejecting the 200-day and still holding. Chainlink had a wild month last month, going as high as 52.50 all the way down to 15 briefly. We did pick up some more Chainlink, and it entered into our extreme value zone, so we doubled up on our dollar cost averaging, picking up some more at around, I can't remember what it was now off the top of my head, but it's on our crypto page. Coinbase. We would expect Coinbase to pick up pretty soon, but right now you only have 2 months of data. So you can see we had a really big opening month in April, and then May, a pretty bad month. It rejected the lows, but it still had a pretty rough, and that's a bearish engulfing candle, so indicating that it's pretty weak. DBO looking strong. There's GDX. You can see it had a 1, 2, 3, 4 in a row of sell-off. Then a little doji, but it continued selling off. It was right at the 200-day moving average. One for your watch lists, at least I have it on mine, is KSTR. This is the new Crane Shares Star Market 50 Index. Now, this is the Shanghai Stock Exchange Star Market. These are the hot tech stocks in China that you can't get access to unless you can invest in the Star 50 market. This is kind of like, not the same, but it's similar to like the Nasdaq 100, right? These are hot tech stocks, hot companies in China. And for a while, it was just sinking. And this is a new ETF. It opened in 2021. And now it's back where it was when it first opened. It came down for a while, hit about $20, $20.50, and now it's come right back up. I am interested in the Star 50 market, and I like the fact that I can get exposure to it in an ETF here in the United States through Crane Shares, which I also like Crane Shares China Internet ETF, KWEB. All right, I'm going to just do a couple more. Speaking of KWEB, KWEB's had a pretty rough month. Look at that doji right there. So we had this nice rally, 1, 2, 3, 4 bullish candles, and then you had this doji right here. Look at that. Big rejection of higher prices, and then a big, massive bearish candle, the biggest one on this whole chart. And then it comes down and it falls through the 200-day, tries to hold it, but it fails. So now we've had 1, 2, 3 pretty nasty candles in a row coming down. You can see that 1, 2, 3, 4, 5 is about the record here for this. So we could have a couple more months, at least historically speaking, before we see a rebound, maybe even more. It doesn't have to hold that same pattern. But this is what I mean. When you look at a monthly chart, you can see all of this data that you may not be able to see on the daily chart, of course. Lithium really picking up. Pulled back a little. It consolidated some of the gains. Lithium miners pushing higher this month and the last couple of months. But it's begun to break out. Okay, I think that's probably it. I probably need to bring this to a close. Let me see if there's any quick questions I can get to. Solar, by the way, solar 1, 2, 3, 4, 4 months in a row. Now, potentially positive here for solar because it fell through the 200-day moving average, but notice it has a long wick on the bottom. This almost looks like a hammer. Looks like this right here. So when you see something like this, what this is telling you is that it rejected these lower prices. Even though it's a bearish candle, it rejected the lower prices and still managed to close well above the lows. So this potentially can be bullish. Just as this one right here, this almost looks the opposite. This one can be bearish. At the very end of a long cycle, this looks like exhaustion, where you have a long wick and then you have a body here, maybe just a small wick down here. This right here indicates that it tried to go higher, but it failed, right? And so it ends up closing towards the bottom. That indicates that you could see a rollover, and that's exactly what we got in TAN. So TAN peaked out at the end of last year. It's pulled back 1, 2, 3, 4 months in a row, but now it seems to be rejecting those lower lows, and now maybe in June we'll see a turnaround. We're pretty well over time, guys. We're going to bring this to a close. God bless everybody. Have a safe and prosperous rest of your week, and we will see you right back here next time. Take care. Bye-bye.